range of outcomes is very wide. So although we were trading toward the left wall for a long time, getting near the bottom, but the problem with them is there's always the regulatory fiat problem. You know, the regulatory, I mean, for goodness sake, if Tom Harkin got his way, they would all go away. He would just create conflicting regulations that he knows doesn't make any sense. But they conflict enough that they just drive you out of business, right? That's his objective. That's what he's trying to do. That's why he wants to both change 90-10 and do gainful employment, right? You can't do them both. You can't lower price and change 90-10. Doesn't work, right? But he knows this. He's trying to push them into a box. I don't think he'll be successful, but the probability is not zero, right? So you always have, you know, I think of everything in a distribution. And I think that the low probability, high impact events are often higher probability in any industry, in any company, than analysts believe they are. With these guys, it's on the table. We know what it is. And so it's just a matter of putting a probability on it. I personally believe that the probability is low that any of them, except maybe apparently Seco at this point, are going to be, you know, forced into liquidation. But it's not zero, so you have to think about that, and that's part of the reason to do the basket, and it's part of the reason that you don't want to get too focused on, you know, what I actually think is going to happen. My highest conviction case scenario makes many of these things, you know, triples, but right, you have to balance that with a non-zero probability that it's very, very wrong and the whole thing could come undone. Now, I think it's interesting because I acknowledge that low outcome exists, whereas when the short sellers get on it, they're like driving it. That's what's happening. That's what's happening. That's what's happening. And it isn't what's happening. Right? It isn't. There's no evidence that that's actually happening. It's just the market starts to price that in as a very high probability, and that's why we get our opportunities. So to do it the way that I'm talking about, you really have to run a lot of scenarios through your models. You have to understand the way the business works extremely well, what the operating leverage and deleveraging points are, what the balance sheet leverage points are, what the growth opportunities and shrinking opportunities are, what the cost structure is like, so that you can say, okay, well, you know, what if we had this sort of regulatory environment? I mean, we had very, very detailed gainful employment models on the worst case gainful employment rule, and you can still stay in business in a lot of these cases. So, you know, I think that's why I think of it probabilistically and in a range of possible outcomes. So in my portfolio, these have very wide ranges. And so because I own those, I need to have a variety of other things in the portfolio that are more, that have narrower ranges of possible outcomes, that are more reliable, that are more known, that have fewer sort of outside risks that, or have very low probability outside risks that would derail them. The problem with those kinds of investments is that once they go up for a long time, like I own Wireless Towers and MasterCard, and they just go up all the time. You know, ever since I bought them, they go up like every day, except when Dick Durbin passed the Durbin Amendment in MasterCard. But you have to be careful with those because the market stops pricing in the outlier scenario. And the outlier scenario still exists. You know, wireless towers, all kinds of stuff could happen. We can have femtocell. I mean, there's technology risks. There's all kinds of things that could happen. And yet they start to, you know, you have to be careful owning those kinds of stocks too, which is why I like to have a variety of different things in my portfolio.